Welcome to Tech Money Madness, your daily U.S. stock market podcast, May 2026.
Yeah.
So, Apple just printed over $111 billion in revenue, right? Just completely crushing expectations.
Oh, absolutely.
And the market immediately punished them for it. I mean, today you're looking at an economy that's basically suffering from a severe split personality disorder.
Yeah, that's exactly what it is. We're watching this unprecedented tug of war right now.
Right.
It's because you have the sheer gravitational pull of these blockbuster tech earnings, and they're just trying to drag the indices higher. But
That's
then
dread.
exactly, this mounting wall of geopolitical dread that's just fighting to pull everything right back down. It's a total collision of corporate resilience and global instability.
And for you listening right now, that is our mission for today's deep dive. We're going to unpack the mechanics behind this collision. We'll break down the day's index divergence, rip into those gargantuan earnings reports from Amazon, Microsoft, and Apple, and, analyze the fresh economic data that has the Federal Reserve completely fractured.
Yeah, they are a mess right now.
Right. And then we'll highlight the specific market movers you need to track. But before we even look at the first chart, there's a foundational ground rule we really need to establish today.
Yeah, this is important. Our sources today deal really heavily with the ongoing U.S.-Iran conflict and, its ripple effects across the global economy.
Right. And we want to be absolutely clear with you. We maintain strict neutrality.
100%.
We are impartially reporting the economic impacts, the data points, the supply chain disruptions, exactly as they're detailed in our source material.
Yeah, we aren't taking sides here.
No, not at all. And we are not endorsing any political viewpoints. Our sole mandate is just analyzing how these geopolitical events are actively moving your portfolio.
Right. We're just tracking the flow of capital and, the repricing of risk. That's the only lens we use.
Perfect. So let's look at the actual tape. The Dow Jones fell 0.8% on Monday.
Right.
While the S&P 500 and the tech-heavy NASDAQ 100, they barely registered a scratch.
Yeah, it was nothing.
They dipped slightly negative, but were essentially flat against the Dow slide. So what's driving that clear divergence?
Well, look at the composition of the Dow, right?
Yeah.
It's heavily weighted toward traditional industrials, legacy financials, and sectors that are just highly sensitive to input costs.
Okay.
So when the market prices in the U.S.-Iran conflict, they immediately price in a spike in crude oil.
Oh, right.
And rising oil acts as a direct tax on those traditional sectors. It just instantly compresses their margins, which, renews broader inflation fears across the board.
It's like a driver tapping the brakes on the highway, right?
Yeah, exactly.
Like, it's not a full crash, but they are definitely cautious. But wait, if inflation fears are renewing, why is the NASDAQ 100 holding the line?
That's the fascinating part.
Because historically, right, high-duration growth stocks in the tech sector, they're like the first to bleed when inflation and geopolitical risks spike.
Oh, historically, absolutely.
They're quintessential risk-on assets. So why are institutional investors suddenly treating Silicon Valley like a Swiss bank account?
Well, it's because the paradigm of what constitutes a safe haven has fundamentally fractured.
How so?
I mean, in previous decades, a geopolitical shock meant you just rotated into consumer staples or gold.
Right, the classic defensive plays.
Exactly. But today, you look at large cap tech and you see balance sheets that rival the GDP of mid-sized nations.
Wow. Yeah.
They're sitting on mountains of cash. And their primary products like software, cloud computing, AI services, they're largely insulated from the physical supply chains that get disrupted by conflicts in the Middle East.
So instead of rotating into defensive utilities, institutional money views a fortress balance sheet as the ultimate defense.
Yes.
It's kind of like realizing the most heavily armed pirate ship is actually the safest place to hide during a naval war.
That's a highly accurate way to visualize it. I like that.
Yeah.
Their cash reserves and high margins, they just provide a shock absorber that legacy industrials simply don't have. But, keep in mind, this slight dip we saw across the indices today, it's really just the prelude.
The calm before the storm.
Oh, completely. We are standing on the edge of the busiest week of the Q1 2026 earnings season. We have a staggering 3,213 companies set to report.
That is massive. And we aren't just talking about mid-caps here.
No.
The docket includes Palantir, Disney, Uber, McDonald's, and AMD. Like, we're about to get a definitive read on enterprise software, consumer streaming, gig economy logistics.
Global fast food.
Right. and semiconductor demand, all in a 72-hour window.
It's the ultimate stress test for the American consumer, truly.
Which brings us to the behemoths that I've already reported, because smoothly transitioning from tech indices to the actual earnings, these tech titans are essentially anchoring the entire market right now.
They're holding up the sky.
And the numbers are defying gravity. I mean, look at this data. Amazon posted 17% year-over-year sales growth.
Huge.
And the main driver there is triple-digit AI revenue growth, plus massive expansion in e-commerce, AWS, advertising, and the rollout of their new Amazon Leo satellite broadband service.
Yeah, let's pause on that. That triple-digit AI growth, that is the critical signal for institutional allocators right now.
Why is that the specific signal?
Because we've spent the last few years enduring this crazy hype cycle, right? Everyone was asking when the massive capital expenditures in AI would actually generate a real return on investment.
Ah, the ROI question.
Exactly. And Amazon is proving the ROI is here. The compute demand for training models and running inferences is actively translating into exponential revenue growth for AWS.
Wow. And then, I mean, you factor in Amazon Leo.
Right, which is wild. Low Earth orbit satellite broadband is just incredibly capital intensive up front.
Oh, I can imagine.
But Amazon isn't just trying to become an ISP. They were building proprietary infrastructure to expand their total addressable market globally.
Okay, wait, explain that.
So if they connect a remote region in Southeast Asia or, say, rural South America to the internet, those users are instantly plugged into the Amazon e-commerce funnel.
Oh, wow.
Right? They view Amazon ads, the local businesses they start run on AWS. It's a completely vertically integrated ecosystem from the stratosphere all the way down to the delivery van.
That's unbelievable. And speaking of ecosystems, we have to talk about Apple.
Yes, let's talk about Apple.
Because they crushed Wall Street expectations, posting $111.2 billion in revenue, fueled by record demand for the iPhone 17.
Massive numbers.
But here's where I'm looking at our sources and seeing a severe contradiction. I got to push back on this.
Okay, what do you see?
The data says Apple printed over $111 billion, crushing the whisper numbers. But it also says their stock declined today. It actually weighed down the broader market.
Right.
Like, I know the cliche is buy the rumor, sell the news, but why would institutional money punish a company for executing flawlessly?
Well, you have to separate the trailing performance from the forward multiple. Okay. Markets are discounting mechanisms. They price in the future, not the past. So investors fully anticipated this blockbuster quarter that was already completely baked into the stock price.
So they already got their win from that.
Exactly. But when the big funds look at the horizon, they see the geopolitical fears we mentioned earlier.
So the $111 billion is already ancient history to them. They're worried about the iPhone 18.
Precisely.
Yeah.
Because Apple is extraordinarily reliant on globalized supply chains and, discretionary consumer spending.
Right.
So if the U.S.-Iran conflict escalates, driving up freight costs, disrupting manufacturing hubs, and just ultimately making everything from gasoline to groceries more expensive,
global consumer confidence takes a massive hit.
Exactly. A fund manager will look at that flawless earnings report, decide the macroeconomic environment is getting way too hostile to sustain that growth rate, and they just take their profits off the table to reduce risk exposure.
So basically, the company is executing perfectly, but the neighborhood they operate in is catching fire.
That's a great way to put it, is risk premium repricing in real time. But, while Apple faced selling pressure, look at Amazon's trajectory based on today's report.
Oh, yeah.
Amazon only needs a 4% gain from its current level to cross the $3 trillion market cap threshold.
That is insane.
They're positioned to become only the 5th company in history to achieve that valuation.
And just to round out the tech picture, Intel is actually showing genuine signs of a turnaround.
Yeah, that was a surprise.
Right. They hit 7.2% year-over-year revenue growth, bringing in $13.6 billion. And crucially, they improved their gross margins. And Microsoft also posted incredibly strong results.
Yeah, and Intel's gross margin improvement, that is the metric to watch.
Why margins specifically?
Well, for a legacy foundry trying to claw back market share from Fable's competitors, revenue growth without margin improvement is really just buying market share at a discount.
Oh, I see.
Right? The margin expansion indicates their newer fabrication processes are actually yielding better, giving them real pricing power again.
Okay, that makes sense. Let's take that thread about consumer confidence and the macro environment, though, because the economic data we got today explains exactly why the market is sweating Apple's future sales.
Yeah, the macro picture is rough.
It is. Core inflation hit 3.2% in March.
Ouch.
Yeah. But the producer price index, the PPI, only rose 0.5% for the same month, which was significantly less than economists modeled despite the geopolitical supply chain shocks.
Right.
Meanwhile, internationally, the UK economy unexpectedly grew 0.5% in February.
And that spread between the 3.2% core CPI and the 0.5% PPI is just a crucial divergence.
How so?
A cool 0.5% PPI print suggests that upstream supply chain pressures might be easing,
Okay.
which typically serves as a leading indicator that consumer inflation could soften down the road. However, 3.2% core inflation is still well above central bank targets. It creates an incredibly tricky needle to thread.
Which is manifesting as an absolute fracture within the Federal Reserve.
Well, they are completely divided.
Right. Our sources highlight a stark division among policymakers. You have officials voting against the post-meeting statement, explicitly refusing to signal any future rate cuts. And then Fed Governor Waller is on the record stating current conditions are, quote, complicating their approach.
Yeah, complicating is the diplomatic term for being trapped in a corner.
Right.
The Fed relies on models that work wonderfully in a vacuum but completely break down when confronted with external geopolitical shocks.
And New York Fed President Williams is practically sounding an alarm bell. Like he's explicitly warning that the conflict will slow economic growth while simultaneously aggravating inflation.
It's the worst of both worlds.
And overseas, in Europe, the ECB and the Bank of England are facing the exact same pressures and are expected to just stand completely pat this month. It feels like the central banks are like a committee trying to drive a car where half the members want to hit the gas with rate cuts, and the others are staring in panic at the check engine light of the U.S.-Iran conflict.
That's a perfect analogy. The structural problem is that their primary tool, the interest rate, is a blunt instrument designed to cool demand.
Right.
But the inflation we're seeing, driven by rising oil prices from the conflict, is a supply-side shock. Hiking rates doesn't pump more oil or, clear shipping lanes. It just chokes off business investment and hurts consumers who are already paying more for essentials.
So they're stuck.
Completely. You have half the Fed wanting to cut rates to support slowing growth, and the other half terrified that cutting rates will unleash a second wave of inflation.
Yeah.
Paralyzed is the right word.
And the consequences of that paralysis are highly visible. To bring this out of the theoretical realm of central bank policy for the listener and just put it into everyday reality, look at this wild commodity stat.
Yeah, this one blew my mind.
Cattle futures contracts have surged more than 25% over the past 12 months.
Insane.
They are hitting absolute record highs just as the summer grilling season approaches.
And when forward pricing mechanisms for commodities are locking in at a 25% premium over last year, that cost inevitably flows down to the supermarket meat counter.
Yep.
It just highlights the severe vulnerability of the physical economy. Tech giants can insulate themselves with high-margin software, but anything requiring land, feed, diesel fuel for transport, and refrigeration, it's entirely exposed to this inflationary environment.
So we have the stark dichotomy. You have artificial intelligence propping up the digital economy, while geopolitical anxiety acts as a tax on the physical economy.
Exactly.
So how did that bizarre mix of blockbuster AI earnings and macroeconomic anxiety actually hit individual stock prices today? Let's look at the market movers.
Well, the divergence was visceral on the trading floor today. The winners and losers cleanly mapped to the structural divide we just outlined.
Okay, let's break it down. We saw Micron Technology surge 6% today,
Yeah.
driven entirely by bullish commentary surrounding their AI chip demand. But on the flip side, Goldman Sachs dropped 1.8%. They took a direct hit from the geopolitical tensions and rising oil prices, pulling the broader financial sector down with them. And Broadcom also saw declines.
So Micron's 6% surge just confirms that the hardware supercycle powering AI is not slowing down. High bandwidth memory is the bottleneck for AI compute, and Micron is positioned right at that choke point.
Right. But what about Goldman?
Well, analyze the Goldman Sachs drop. Why does a premium investment bank lose value when oil spikes?
Why?
Because geopolitical uncertainty is the death of deal flow. When corporate boards can't predict the cost of capital or the macroeconomic environment 6 months out, what do? They shelve their M&A plans and delay IPOs.
Of course.
And the lucrative advisory fees that power Goldman's revenue just dry up entirely.
The risk premium gets too high, so the checkbook slams shut.
Exactly that mechanism. And looking at the trading volume, the liquidity is heavily concentrated.
Yeah.
Apple, Amazon, and Microsoft were the most active stocks today.
That makes sense.
Institutions are crowding into the largest, most liquid names because they offer the easiest entry and exit points in a volatile tape.
But let's look outside of big tech for a second, because the sources point to a highly specific catalyst providing a tailwind for the retail sector.
Oh, the tariffs?
Right. Companies like Walmart and Target are expected to be major beneficiaries of upcoming tariff refunds. In a tape where retail usually gets crushed by supply chain costs, this is a distinct bright spot.
Yeah, the accounting around those tariff refunds is critical to understand. Tariffs are a direct hit to a retailer's gross margin.
Right.
So a refund acts as a sudden, non-recurring injection of capital that drops straight to the bottom line. For Walmart and Target, this influx of cash serves as a vital shock absorber.
Oh, I see.
It gives them the balance sheet flexibility to absorb higher wholesale costs, like that 25% spike in beef prices we just discussed, without having to pass the entirety of that cost onto a consumer whose wallet is already stretched so thin.
It essentially buys them time and protects their market share.
Yes. If you step back and look at the whole board today, Micron rallying on memory demand, Goldman sliding on dead deal flow, retail propped up by tariff refunds, and big tech absorbing the vast majority of volume, it paints a picture of a deeply bifurcated market.
It's a market lacking any unified direction.
Completely.
I mean, the technology sector is operating in an entirely separate reality, fueled by the tangible adoption of AI and cloud infrastructure. Meanwhile, the energy sector is violently oscillating based on every headline out of the Middle East, and the financial sector is taking the collateral damage.
Macro is actively at war with the micro.
We have traversed a tremendous amount of data today. Pulling all of today's sources together, I want to crystallize the big picture so the listener knows exactly what to watch for the rest of the week.
Sure.
Give me the foundational pillars driving this market.
All right, there are 5 definitive pillars currently dictating capital flows.
Number 1.
First, the U.S.-Iran conflict. It remains the dominant geopolitical headwind, dictating oil prices and injecting a persistent risk premium into the market. Second, we are entering the absolute apex of the Q1 2026 earnings season. The sheer volume of reports this week will set the corporate narrative for the remainder of the quarter.
Okay. Third,
Third, we have a paralyzed Federal Reserve. They're internally fractured and structurally incapable of addressing supply-side inflation without damaging growth. Fourth, AI adoption has officially transitioned from speculative R&D to the primary quantifiable growth engine sustaining the entire tech sector.
Wow. And the fifth.
And fifth, we're navigating a global economy flashing highly mixed signals, with unexpected growth in regions like the UK clashing against stubborn, entrenched inflation fears here in the US.
So, to you, the listener, evaluating your own portfolio right now, think about the sheer weight of these conflicting forces.
That's a lot to weigh.
It is. You are standing at the intersection of peak earnings season, a geopolitical powder keg, and a deeply divided central bank. Which of these forces do you think will ultimately dictate your portfolio's performance this year?
That is the defining question for every asset manager this year.
Really is.
And, if there's one final thought to mull over as you watch the tape tomorrow, consider the profound duality of the bizarre reality we live in today.
What do you mean?
Well, in the digital realm, you have tech giants like Amazon launching satellite broadband networks, Amazon Leo to blanket the globe, pushing their valuations to the precipice of $3 trillion.
Right.
Yet simultaneously, in the physical realm, the cost of a summer backyard barbecue is skyrocketing to record highs due to a 25% surge in cattle futures.
Oh, man.
We are operating in 2 distinct economies. The digital, soaring on limitless innovation, and the physical, bound by land, logistics, and friction.
Wow.
The ultimate performance of the market will be determined entirely by the tension between those 2 worlds.
That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.